Good afternoon, everybody. Jay Linder here with President of COPEC. It's 2 o'clock and we're going to get started with today's program. Today we're going to be talking about investment distribution options with Nate Quilter, who is a certified financial planner with Retirement Strategies. And I'm excited to have this discussion. For those of you that have been part of these discussions before, please remember that you can participate. We invite you to participate, send questions in, and we'll have this discussion from 2 to 2:30, and we'll stay around till 3 o'clock if for any reason we have additional questions. And also in the notification, I think the topic was written wrong. It's investment distribution options, not requirements. And so we're going to talk about options and really dig into this. The disclosure, the COPEC disclosure is on here. You can also see this on the copeceducation.org website. This is regarding affiliated companies like mine. I am the president of COPEC. I'm considered an affiliated company. And so therefore you can see some of that extra disclosure there also regarding our company. So want to make sure that's out there. And as far as the program today, we're real excited about having Nate with us. And Nate, there you are, and glad that you're again here with us. And you're a weekly staple of the program every Thursday. So real excited about this discussion. We're going to be really breaking down investment distribution options and kind of, if you can really kind of give us a quick overview, what are we going to talk about today?
Well, really just as it states, the different options you have for taking money out. A lot of people understand, hey, how you save, what are the ways to save, to get to retirement. But whether before retirement or at retirement, well, there could be times where you either want to or need to pull money out of those accounts. So this is really just kind of a discussion on what your options are. We'll talk a little bit about, strategies you can use in some instances. Again, like with anything in financial planning, everybody's situation is a little bit different. There are kind of no rules that work for everybody necessarily. But we'll kind of talk about some options, some things to think about and see if it works for your situation.
Well, why don't we start off with the most obvious? What are some of the options and contributions and ages, and maybe let's break that out. What are some of the top things that people need to know?
Well, basically, there are ways you can optimize it and decide which accounts are best for you from different standpoints. But, a lot of it really comes down to, there are certain times you either have to, or there are certain times that there will be penalties if you were to do it. So I'll kind of start with those where, where would there be penalties? Well, retirement accounts, particularly, 401ks, 403bs, IRAs. These are tax codes that the IRS has that they want to incentivize people to save for retirement. So the money will be there when they're not able to work anymore. So they give you these different positive tax impacts, and because of that, they also penalize if you take out sooner. So for example, IRAs, unless you meet certain exceptions, an IRA, you need to be 59 and a half in a traditional IRA to take money out without penalty. Now that penalty is 10%, and then because the IRA is pre-tax, you would also have to pay tax on that typically. Again, there are exceptions, school, disability, things like that. So you might qualify for an exception and not have to pay the penalty, but you'd still pay tax if it's pre-tax money. Now, you could also as well have Roth IRA, in which case you wouldn't want to touch the earnings, but you can take out your contributions at any age with no tax or penalty. Now, again, going into the strategy part, is taking from a Roth IRA your best option when you're younger? Maybe it is, maybe it isn't. But, again, we want to avoid penalties typically if we can. The next thing is when you have to start taking them, and that's required minimum distributions. So on beneficiary accounts, if you inherit, whether it's an annuity or an IRA, any of those will have restrictions. You must take out a certain amount at a certain point. In addition to your own IRAs will have required minimum distributions, typically at age 72. Again, different rules for different things, but typically age 72, you need to start taking from your own. And the beneficiaries, depending on when the person passed away, it could be you had to start the year after they passed away, or you have up to 10 years to take the full balance out, kind of depending on the rules. But so those are the first things to think of: is can I take it out without a penalty, and do I have to take it out? So those are the kind of the first options. And then from there, it's kind of, do I want to take, why am I taking it out? Should I be taking out things like that? Which one should I be taking it from? Oh, you're on mute.
You're typing in a chat there. There we go. On Monday, we had a good discussion with Jill, the CPA, and we were talking a little bit about this, and this is something for everybody to remember, that there's a lot of overlap as to, we may talk about the rules, but boy, there's a lot of whether you should personally, how do you optimize it? How do you take the best advantage of tax situations? And Nate, we were talking a little bit even about the fact that right now people may have lost a job. And, when is tax brackets going to be the most advantageous? And it's really tough to sit there and say, wow, I just lost my job. But there's a silver lining, because there's an opportunity to do something with the distribution on tax benefits on certain retirement plans. I mean, it's a really hard thing to wrap your mind around when we're struggling finding a job. But there truly is some major windows, depending on age, depending on circumstances, and all these things, where you want to consider these things in a tax effect as well, correct?
That's absolutely right. The different types of accounts have different tax implications by taking the money out. The kind of the major one I would say is probably pre-tax versus after-tax money. So if it's pre-tax money, let's say we don't have to worry about the minimum age we've reached at. We're just deciding whether we want to take money out of an IRA or whether we want to take it out of an after-tax brokerage account. The IRA, every dollar you take out is going to be taxed. So from a just this year, which one makes less tax for me standpoint, you're probably better off with that after-tax brokerage account. And the way those work is, those accounts, you pay taxes on the gains as you receive them, but taking money out of the account is not a taxable event. So it could be, hey, this year, I might be better off keeping my taxes as low as possible, but next year I want to create tax. Every situation is a little bit different, but when you look at the tax system, we're a progressive tax system. So the more you take out, the higher the tax bracket is, the higher the marginal rate can be. But those are, when we say brackets, there are different kind of tiers or windows that are all in that bracket. And then once you go above that, every dollar you go above that bracket is in the next bracket up. There are a couple opportunities where those windows jump pretty considerably, and that's from the 12% tax bracket all the way up to 22. So every dollar you take that's above the top of that 12% tax bracket, those next dollars you take out are going to immediately jump up by 10% tax. It's a tax hit. It's not a penalty, but it's an extra amount of taxes. You're paying 22 cents on the dollar instead of 12. On the flip side, then, if you've got a window under that, if the limit's around 40,000 and you're at 30,000 for a single person, you're at about 30,000 of income. Well, you've got $10,000 that you could take out still at that 12%. So you might, in that case, actually say, if you need money and you're in that 12% bracket with room, a lot of times we'll say, hey, let's go ahead and take it from the IRA. Whereas, if you're already up into that 22 and you don't think you'll ever be in that 22 again, we say, no, let's take it from the after-tax account, because just taking it out is not creating tax. You do need to be aware of how things are invested as well. So it's not just how it's taxed when you take it out. You also want to look at how things are invested to an extent. So, if you're in a taxable brokerage account, you pay taxes on gains when they're realized. So if you have a really low basis and a really high value now, and you have to sell that to get it out, you're going to create some tax. Now it's at capital gains rates, which are favorable, but those could still potentially put you up into that next bracket with, if capital gains are added in on a sale that creates a lot. So part of it is, are you going to be creating a gain that is taxable? And another one is actually how you're invested as far as what the market's doing. Now, I never like to use the term market timing because we're not changing our investments necessarily to try to time it based on the market, but it's more of timing, using the timing of that distribution you need and using what the market's giving you at that time. And what I mean by that is, the market goes up and goes down. Well, if you have a portfolio that's balanced, let's say you're 60% stocks and 40% bonds. Well, if the market takes a downturn, the stock market takes a downturn and bonds are doing better, well, at that point, you may want to take out of bonds instead of out of stocks and give those stocks a chance to recover. Well, depending on how your accounts are invested, you may have one account that's all stocks, and you may have another account that's all bonds, just based on what was available to you and how you've set those up. Or maybe you have each account is at 50-50, however it may be. But you may want to, if one account's all stocks and one account is all bonds, you may want to go ahead and take it from the all bond account if the stocks are down drastically, and vice versa. If stocks are doing pretty well and your returns have been great over the last few years, hey, now might be time to take a little bit of profit out of those stocks and take a distribution out of those when it's time. So a lot of factors come into play in the decision. But
yeah, I want to piggyback on what you just said right there, and use that concept between stocks and bonds and take it one step further and remind people that are listening that it isn't just stocks and bonds. There's also something when you do wise portfolio management, you also do something that is called negatively correlated stocks. So you may have a situation where a certain sector of stocks, the goal obviously is for all stocks and stocks and bonds to do well over time. It's how do they produce or how do they respond on different types of market volatility. So, and the need for liquidity, which is what we're talking about, which is the distributions, is when you need money for distribution, which ones, right? You don't want them all going down at the same time, which is why you're doing the stocks and bonds. But there's also the negatively correlated stock positions, and you strategically create a portfolio that also, so for those clients that are more aggressive, that you may have this sector historically is shown to be negatively correlated with another sector, or domestically and international, or large cap and small cap, and so those are some vague, samples of accounts that might not always do well the same year, right? Or in the same circumstance. So it's not just, and a lot of people do that, the cash or bonds versus stocks, but it's also inside. If you've got $500,000 and you're 80-20, well, you got a lot of stocks. You want to make sure that those have a certain negative correlation so that not only the portfolio, and I know we're on a tangent here with portfolio management, but the entire portfolio has a little stabilization from volatility, because while one's doing poor, the other one, they bounce back and forth maybe. But when you're taking distributions, that is huge, because you want to make sure that you have options when things are volatile, when things are poor and you need to take distributions.
Absolutely. And as you mentioned, when you build your portfolio, there are funds you can do that are what are called balanced funds, or even those target date funds, your retirement 2020 funds as an example. Those are balanced type funds. So it's mixed in of a broad portfolio, but if you're making a distribution from that, if let's say it's at a 60-40 mix, if you're making a distribution from that, you're taking out 60% stocks, 40% bonds as an example. You can't pick and choose and say, I'm only going to take bonds on this distribution, because the holding is already mixed. So as you mentioned, if you build that portfolio that's very, diversified in negative correlation, or even just not fully correlated in general, some things are going to be up while others are down, and vice versa. But even that, maybe not up as much. So as an example, this year, large cap growth stocks have done very well, where small cap value stocks haven't. So they're both stocks, but the one may be the better one to pull at a certain time and give the other one time to recover.
Right.
So absolutely, yes. Having that a well-diversified portfolio, is one of those where there's always going to be something in the portfolio that you're like, oh man, I'm not doing that well in that one. It's just the way it works, because you want ones that act differently than the other ones. And especially,
when you say that, you mean momentarily.
Exactly.
That doesn't mean its 3-year or 5-year average is worse than the other. It just means when something bounces or gas prices go up, or some of those things, they may react differently to different situations. But that doesn't mean you're trying to get something to lose money over 5 years. That's not what we're saying.
That's exactly right. Yeah, that's exactly right. Just the gas oil companies did horribly earlier this year because nobody was driving to work. Whereas Amazon was doing great because nobody was going to the retail stores. Those are both stocks, and they can even be both large cap stocks, but they're going to act different. As you mentioned, you're not looking for something to underperform for a long period of time. You just know at that period that one was not doing well while the other one is. So,
back in 2008, bank stocks took a big hit, and various other, and you talk about diversifying, but that doesn't mean you don't want it. But diversification has a very close connection to how you take distributions, and you can also use those distributions to rebalance. So while something does well, you take from there, and it automatically rebalances your portfolio. So people that are retired, that rebalancing naturally happens, but you have to be willing and able to take distributions from different accounts depending on what the volatility is.
Right. Yeah, it's a little extra work, but if you do it, it can absolutely be more than worth it to take that extra time and understand what you're doing, why you're doing it,
and a lot of times these are the missed earnings that people don't always see, that pay for themselves if you pay attention a little bit more. That are valuable, that add up quite a bit over time. So
absolutely, a couple $1,000 a year over 30 years ends up being a significant amount of money.
Right.
It's a couple thousand. If you take extra out because you didn't plan well, you're paying extra taxes on. You might be doing, if you are doing it in a tax inefficient method, you're going to be taking extra out to pay more taxes on it, and then it's not growing. So it can really have a big impact over time.
Yeah, and it's interesting because also when you talk about these distribution strategies, it is really sometimes the reverse of the contribution strategies. Not for everything, but like sometimes people ask us, should I contribute to a Roth 401k or a traditional? Well, it depends. Have you got your income increase? Maybe you started in September, so you have a whole year where you don't have high income. So that means do the Roth, even though next year we would change our opinion because what we project your tax liability to be. And same thing on the back end. There's situations that really change that. I wrote down a couple questions here. Can you talk a little bit as far as how to take advantage of taxes on gains or Roth conversions or some of those things?
Yes, absolutely. There are a lot of times, especially when you're looking and making projections out, looking 5, 10, 15 years down the road, and looking at, what your projected tax rates are at the time, that can open those opportunities for Roth conversions or taking gains in particular years. And it can be sometimes if let's say you need to raise some money for a distribution and it's an after-tax account and you take a gain. Well, you may want to also sell something that's down a little bit to have it offset that gain, so you're not paying as much tax. Your gain isn't as much because it's offset by that loss. So that can be a good strategy. So you're not creating as much tax. You're realizing some of that gain, so your account doesn't have this really just grow, and then you have this giant gain that eventually you don't want to sell anything because it's going to create such a large gain in taxes. So absolutely, you know, there are kind of tax loss harvesting, that's called, basically selling losses on purpose to an extent to offset some gains. But Roth conversions, you know, as you mentioned, should I put in the Roth 401k or traditional 401k? Well, we've seen situations where, let's say somebody's only working for another 2 years, and while they're working, they're in a really high tax bracket, or, you know, pretty high tax bracket. And then they retire, and their tax bracket could be almost nothing. You know, if they're living off cash and maybe starting Social Security, which isn't taxed as much as IRA distributions. But so, you know, hey, maybe we're going to be in a really low tax bracket, but then at age 72, when the IRS says you have to take required minimum distributions, now our tax bracket jumps back up to that high one again. Well, there's that window of low tax brackets that you may say, hey, look, I'm going to go ahead and take from the IRAs. And I don't need it to live off of. Maybe I'll just go ahead and do Roth conversions, which is taking money out of an IRA and paying tax on it and converting it over to after-tax Roth money. And those Roth IRAs don't have required minimum distributions. So, you know, if those required minimum distributions are going to kick you up to a higher bracket later, and it's money you don't necessarily need to live off of it, now you look at that opportunity where you're in a low tax bracket and say, hey, I'm purposely going to take tax or take money out of this and pay tax to do it, to put it in an account over here that I'll never have to pay taxes on again as long as I follow the rules, and I'll never have to take required distributions again or on that money. So sometimes sometimes we're trying to avoid tax and sometimes we're trying to create it, but it's really hard to know which is better until you can see those different time frames. And, you know, you really have to be thinking ahead and looking at those different time frames to look for that opportunity. As you mentioned, you know, why would you put in the Roth money if you're going to retire in 2 years and be in a much lower tax bracket when you could put it in the pre-tax at a higher tax rate and then take it out at a lower tax bracket?
Nate, we got a question here that was asking, and correct me if I'm wrong, if I'm saying this wrong, but somebody had a question regarding taking distributions either on a monthly basis or when you need it. Is there some kind of a purposeful strategy that you would recommend as to how you should take money out of accounts, you know, for those distributions?
Really depends on everybody's situation a little bit differently. Just kind of psychologically, you know, if you're used to the last 40 years you've been working and receiving a paycheck every 2 weeks or every month, whatever it may be, we found with clients a lot of times they like that. Just, hey, every month on the first of the month or whatever day of the month it is that they choose, I want X amount of dollars to be in my bank account. And that's it, you know. So then it's, you know, we make the decisions on which account, you know, and which fund to pull the dollars from, you know, stocks, bonds, all that kind of. But then it's, hey, every month on the first of the month, the money's just in their account. So it's a lot of times I'll suggest that for clients if we know over the course of the year we're going to need $60,000. Well, let's just take $5,000 a month as an example. And so it's just, instead of feeling like you're broke for a month because you're doing it quarterly, whatever it may be. So I think just it's a lot of people like that steady paycheck, and that's probably how the majority of our clients take distributions. Now, with that said, let's say that we needed that $60,000, but let's say that $5,000 of it was for a one-time trip or a long-term care policy premium, or just something that, you know, is a home repair that you had. Instead of dividing that up over 12 months, maybe, you know, let's say we needed 60, but 10,000 of it was a one-time lump thing. Well, let's just go ahead and send out 50 over the course of the year. And when that event happens, we'll send that 10 out. And so a lot of the reason for that is just some people aren't as good at budgeting. You know, it's, hey, if they know that month they have this month to spend, they're going to spend it. Well, if you're putting that travel fund in January and they're not going till August, they may spend that money, and then it's August and they're like, oh, you know what, I spent that money already, I need it for a trip. And that can kind of cause them to overspend, which over, again, let's say it's a 30-year retirement, you know, not budgeting correctly can have a big impact. So that's kind of a way to force yourself to budget a little bit. If you save up those big distributions or those one-time things and make a one-time distribution at them. But overall,
Yeah.
I think people like the monthly.
And maybe I'll use that as a point to clarify that we do with clients many times is a lot of times we get questions similar to this where it's like, how do I get my money? Right? And there's a lot of confusion. And while there are rules, in general, you can get the money whenever you want. Usually the rules might contain a penalty, but most people know those. Outside of that, a lot of it is optimizing what is best and saves you money over the long term. So when a lot of people ask, I don't even know how to get money. Well, distributions, annuitizations, there's a lot of options for people to get money from most of their accounts. So just know that it's very, very liquid. And when you were talking about these distributions, and I think the question that the gentleman asked was valid in the sense that there are a lot of people that do usually one of two options for distributions from investment accounts, right? Because you're automatically getting your Social Security in retirement, and you're automatically getting a pension if you get a pension, whether it's a state pension or a private pension, or maybe you have something you did on annuitization or a settlement or whatever it might be happening, or even income from a rental property, right? Those are happening automatically. So they're always trying to figure out, how do I deal with those distributions from an investment? And I would argue that usually it depends on the type of person, and you tapped on that, which is, are you a budgeter or not, right? Some people, I don't want any money in my bank account because if it's there, it's spent. So I want to have it doled out because I want to control it. That way I get $5,000 a month, and when it's gone, it's gone. I don't want to know that, whatever it might be. And in general, people are pretty good. On the flip side, there's a lot of people that, look, I want I have $100,000 sitting in my bank account, and I want the $5,000 just added to it, and I'll pay myself because I'm a good budgeter. I control it. And maybe I want one payment. Sometimes for requirement of distributions or payments, we just send them $60,000, and that their $100,000 goes up to $160,000, and they control it, and it doesn't matter. It's really whatever you want. The nice thing about the monthly is it just helps you control it, but also it allows us to do the reverse of dollar cost averaging, right?
Right.
It allows us to control how we take distributions out, and we're not pre-guessing anything. Some are high, some are low. We try to we try to time it as best we can based on short-term volatility. But in general, those are really good things for people to consider. I just noticed that we're over, Nate. If there are any other questions, please feel free to send us a note, a question. We appreciate people participating. I guess just to wrap up, Nate, if you have a quick thought, and we're trying to stick to this half-hour time frame.
I appreciate your time today, and thank you for having me. And I think the real thing is just know that go in and do it with a strategy. I'm the planning presenter here, so I like to plan everything. So go in with a strategy. A lot of times people just take a distribution and then you have to kind of fix it later. So it's a lot better to go in with a plan, knowing, hey, when these come up, this is how I'm going to handle it. So thank you again.
Well, good. Thank you. And again, if anybody has any questions or concerns, feel free to reach out to Nate or myself. We'll help you out as best we can. Otherwise, take care. Have a wonderful afternoon. And we'll see everybody tomorrow. Take care. Thank you, Nate. And thank you, everybody, for being here.
Bye, guys. Thank you.
All right. Bye-bye.